Hi there, Cheryl from Cheryl Davie Real Estate here. I am sitting today with
Eitan Pinsky Mortgages.
And we are going to talk a little bit about interest rates and how they affect the market. So today we are sitting in January of 2022, and over the last year we've had an extremely busy market in the real estate world, and a lot of the messaging that we've been hearing, especially in Q1 of 2021 and Q2, is what was driving the market were historically low interest rates. And I do know some of my clients that were completing in that time, they got numbers, they would call me and tell me like, I just closed on a 1.5% 5-year fixed rate, and like I was like, should I renew my mortgage? Should I break my mortgage? Should I sign in? Which obviously we talked about, and I went and talked to my bank, but that's aside. Today, what we are hearing is that the rates are going to go up. And I think from buyers' perspective and sellers' perspective, hearing throughout that time period that what was really driving the market was these historically low rates, the question now is how are increased rates going to affect the market? And before you start, I think from a buyer's perspective, people are really hoping that it's going to really slow the market, and they're thinking that other people, not themselves, but other people may be heavily affected by the rate increase. And so I'm just wondering if you can talk about how approvals are affected by that, and what you might see coming in the market in the coming months, hearing that we're going to have rate increases.
Awesome. Thanks, Cheryl. So rates are increasing. Is that going to affect people's buying ability? Well, everybody knows that we have something called a stress test. The stress test has gone from 4.64, 4.74, 4.79 over the past few years, and right now it's at 5.25. So what that means is that you have to qualify based on paying a rate of 5.25%. So when somebody is actually purchasing a property and they get that $1.5 million mortgage, they're already qualifying and assuming that their payment is 5.25%. So I guess the first thing that I wanted to say is that people are buying properties and they can afford it. And the banks are looking at it and they're saying that, okay, even though the rates could increase in the future, that ability for you to absorb that increase in payment is already built into the mortgage. So one of the things you touched upon is, will increasing the interest rate, or will the increased rates right now stop people from purchasing?
Yeah.
I think there are some people who come to us and say, I'm going to purchase this property. I really want the best rate possible. Actually, everybody wants the best rate possible. Everybody wants the best rate possible. But would that person not purchase a property because the rate is 0.5 higher? 90-something% of people, and if they're buying their own property, a property to live in, no. The answer is 100%. They're going to buy the property regardless of what the rates are going to be. Mm-hmm. They still want the best rate. There may be some people who are buying investment properties, and they look at their pro forma, they look at the income statement and the net operating income, and they say, you know what, a higher interest rate would preclude me from purchasing this property. In most cases, if, for instance, a rate of 1.5 and it goes up to 2.5, and that stops you from purchasing that investment property, it's not a good investment property to begin with. You should already build that in because we know the rates are going to increase. So that's a great question. Now, do I feel like the increase in interest rates are going to change
the activity in the market? Will it slow the market?
I don't think so. I think, again, it all depends on the purpose of that purchase. I'm not seeing that people have a difference. So people tell me, should I pull the trigger now, or should I refinance now? Should I purchase now? Vis-a-vis the interest rates. I think the most important advice that I could give somebody when it comes to interest rates are, could you see yourself living in this property? Could you see yourself living in it for 4 years, 5 years, even 3 years? And when you talk to Cheryl, or you talk to your realtor and you say, okay, I'm going to purchase this property for $800,000. If you talk to your realtor and say, I'm willing to live in this property for $800,000, but I'm also willing to live in it for $810,000. I would bid $10,000 more because I really like this property. People think that interest rate is that important. A 0.5% increase in interest rate from 2 to 2.5 would probably be about $8,000 difference in interest over 5 years. So people look at people look at the interest rates and they say, hey, this is a big impact. But your offer and how much more you bid on a property is way more important than that small interest rate change. So when we say hey, should I wait or should I change what I'm doing with my strategy because of the interest rates that may or may not increase in 2 months or 3 months? I really think it's a moot point. Yes, we're going to try and get you the best interest rate possible. We're going to lock you in and get you an interest rate that if it increases within the next 4 months, you'll get locked in and you'll have that great interest rate. But I wouldn't pull the trigger on a bad property or a property that you're not 100% keen on just because you're going to get a slightly higher interest rate in 4 months or 5 months.
Right. Yeah, no, that makes sense. And I think what I always speak to people about too is often, people come to me, they may have already talked to their bank, they may have already talked to another broker, and I always encourage those people to go and get a second opinion. And a lot of times what people don't understand is that the rate itself is not the best part of the mortgage. It's always about the terms. And you will see some of the larger banks that will advertise a 0.99 or a 1.99 interest rate, and people just think, that's where I should be going. But when you look at the terms that are involved in that, you're really not going to come out ahead if you end up having to sell sooner, right? Like some of the mortgage providers out there, monoline lenders, will have a much better prepayment penalty. And if you decide to sell in 3 years, if you're at one of the larger banks with this really sexy, appealing interest rate, but you have a $30,000 prepayment or penalty, are you really getting ahead in the end? And I think a lot of times the answer is no. So that's what I do, is I counsel my clients to get a second opinion and ask those questions about the terms. What is your prepayment penalty going to be? How much can you prepay? All these kinds of things, which make up, to me, there's so much more than just the interest rate. All right, so I just want to go back and ask you a quick question about the rates. Where are they now? Where do you think they're going? And maybe you can talk about what the market has done historically when we have had different interest rates.
Awesome.
People are so used to these ultra low rates, I don't think they know or forget what it used to be like.
100% correct. People are used to ultra low rates. For the last 2 years, we've had rates that have never been seen before in the Canadian market. I'd say that the 10-year average, 15-year average has been about 3%, a little bit over 3%. So when people say, and that's fantastically low. In the 30-year average, they were at 6%. I think your first mortgage was at
6, maybe even 6.5% in 2006, I think.
And your current mortgage?
Well, I've just renewed, so I will be coming in at, I believe, 125.
On
a variable.
On a variable,
on a
correct.
Variable.
So
yeah, which is amazing.
We can have rates as low as 0.99 for insured mortgages, up to about 3% right now. I think people have to remember that when you have a 3% rate, and when they went down to 2.99, I think this was about 11 years ago. I started at a big bank, and that big bank had a flashy 4-year at 2.99, and it made all the headlines. Everybody was losing their marbles. Yeah. And then some people got a 5-year at 2.99, and then it just went down from there. I think the most important thing to realize is that rates are going to move. We should want the best rate that we can get at this time, but when it comes to interest rates, and we're still on most mortgages under 3%, we're probably going to go to 3, maybe 3.5 over the course of the next year, but that's a fixed rate. So remember that fixed rates are rates that get affected directly by the
bond yields?
The bond yields, exactly. So fixed rates are not something that you can always know what's going to happen. They go up if the market is doing very well. They go up when the market is doing well, and they go down when the market is uncertain. And so the reason why we had really low rates over the last little while is the big elephant in the room, or the big spiky elephant, COVID. I'm trying to make jokes today. Made people very uncertain about what was going to happen in the market. And so when the market isn't doing very well, the government wants to help as well, and then the variable rates are affected. So the government has direct involvement with variable rates, and they'll say, hey, Mr. and Mrs. Small Business, you can borrow money from us to invest in your business at low interest rates. And that's the whole primary factor of low variable rates, is the government wants to spur investment. They want to make the market go better. But then the housing is directly involved as well, because they say, okay, the variable rates are going to decrease. Now you can borrow for your home on the variable rate at a better price. So right now, 1.25, that's actually unheard of. It's never been that low in Canadian history.
Okay.
Again, 0.99% on a variable, never been that low. I remember when Investors Group did a 3-year variable at 1.99, and again, that was huge, and that was what, 5 years ago, 6 years ago? Long story short, rates are going to go up. We've been regulated to have extremely low rates, and we should all feel lucky, I think, that if we're going to be under 3.5, it's still fantastic. Sure. I hope people don't get really angry at me for, okay, you should be happy for having a 3.5% interest rate, but in the grand scheme of things, when the market does so well and our rates are still very low, nobody wants things to be taken away from them, but we should look at what has historically happened, and rates have been much higher than what they have been historically.
All right. I think that answers the question.